So you have extra money coming in every month and you're thinking about taking that money and putting it towards your mortgage and paying off your home faster. If you're thinking about doing this or you're currently doing this, I want you to stop what you're doing and listen to today's episode. You do not want to miss it. If it's your first time here, my name is John Boyd. I'm a certified financial planner and I'm the founder and lead wealth advisor at Modern Wealth. That's modern spelled with no vowels, wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. I want to welcome our listeners from the Emerging Wealth Podcast, a podcast dedicated to tax and financial education for high-income millennials. And today's episode is definitely an issue this demographic faces a lot. Having extra liquidity, extra cash flow come in, and not knowing how to effectively deploy that capital. A lot of folks, their first inclination when extra money starts coming in is, hey, I should pay off my home faster. And we're seeing this more and more because rates are higher, right? Folks are getting mortgages that are, let's say 6.5%, sometimes 7%. And they are thinking, well, that's a terrible deal. I'm getting robbed by the bank. I should rush to pay off my home and own my home outright. And then once I do that, I can start saving for real because that mortgage is so big. It's just robbing me of an opportunity to effectively save. So I'm going to rush to pay off my home so I can save better. That's a smart idea, right? I wholeheartedly disagree with that approach. I think it's highly ineffective. I think the argument of, well, my mortgage rate is 6.5%. And my investment returns are 5%. Therefore, because my mortgage rate is higher, I should just pay it off. I think that's really backwards and ineffective math. Bottom line, at the end of today's episode, I think you're going to have a better idea of how debt financing used responsibly can not only allow you to accumulate wealth, but accumulate wealth in a way that's more effective on your balance sheet. Because this is a really underrated element of wealth accumulation, right? It's one thing to have just a high net worth on paper, right? It's one thing to say you're a millionaire on paper, but how are you a millionaire, right? If all your money is tied up in your home and you only have $10,000 in a checking account, well, you might be a millionaire on paper, but you're not living a millionaire lifestyle, I'll tell you that much. Balance sheet optimization is really, really important when you build wealth. So let's go ahead and dive into it. This is why I believe you should stop rushing to pay off your home and instead deploy that capital in different ways. So let's dig into an example. Before we dig into that example, if you enjoy today's content, I want you to go to the description of this episode, click on the link that goes to our blog, and join our weekly Planning Insights newsletter. There'll be a button in the top right that says join our mailing list. We send out a weekly newsletter with planning insights from everything from taxes, estate planning, investing, and more. You do not want to miss it, so go ahead and subscribe. So let's use an example as to why I believe paying off or rushing to pay off your home and adding extra money to your principal every month is a bad move and leads to really inefficient balance sheet optimization. Okay, so let's just use an example. Let's say it's January 1st, 2023. You buy a home, it's a $500,000 home, and you put $50,000 down. Okay, so you end up with a $450,000 mortgage, a 30-year fixed at 6.5%. Okay, 6.5%. That's a lot higher than maybe some of your friends that are bragging about their 3% mortgage, right? So you got stuck with a 6.5% mortgage. Ooh, that's bad, right? Not so fast. So yes, your mortgage principal and interest is $2,844 every month. Okay, that doesn't include property taxes, PMI, none of that. Just principal and interest is $2,844. So you're here, right? You have extra money coming in. to the tune of $2,700 every month. You have extra money left over every month. And you're going online and you're seeing everybody talk about how you should rush to pay off your home. You're seeing these financial gurus talk about how having any debt at all is bad and you should pay off your mortgage quick. And you're also sick of hearing your friends brag about, their 3.5% mortgage that they got a couple years ago, and you feel like you got gypped. And to make matters worse, the thought of paying all this interest to a bank drives you crazy. So what you go ahead and do is, with that $2,700 surplus that you're getting every month, you decide to add that to the principal of your home every month. Now, based off that math, your home would be paid off in roughly 9 years. Okay, so in 9 years, at $2,700 a month extra to the principal every month, your home would be paid off in about 9 years. Okay. Now let's also assume a 5% annualized growth rate of your home. After 9 years, that means that you have not only paid off your mortgage, but you own your home free and clear, a house that is worth $775,000 approximately, because it's grown over time. So at a glance, that seems like a pretty good deal. At 9 years, you've paid off your house. It's worth now $775,000, so it's grown in value. And now you can start saving for real because you aren't getting held back by this big mortgage anymore. No, you can actually start saving for real now, right? Well, let's look at a different scenario. What if you say, you know what, I'm going to start saving for real now, right? I'm going to go ahead and take that extra $2,700 I'm getting every month, and I'm going to put that, let's say, in a brokerage account. And I'm going to invest that money. Now, let's be really, really conservative here. And let's just assume a 5% rate of return annually, compounded annually. And you do that for 9 years. Well, 9 years later, you're going to have around $357,000 in this brokerage account. Again, this is assuming that you're already putting money away in your 401k. You're already doing all that, but you have this extra money. What do you do with it? So you just go ahead and you put in this brokerage account, and voila. After 9 years, $357,000. So let's just recap these two different scenarios. Option A, you take that $2,700 extra every month and you rush to pay off your home. After 9 years, you got this $775,000 home, but you don't have anything else. You have nothing else. You have maybe your 401ks, but that's it. Nothing else. You're debt free. That's cool, but nothing else. Nothing else to your name other than your home and maybe your retirement accounts. Now think about this, right? 9 years have gone by. Imagine you're 30 years old, 35 years old. You're well into your 40s now, potentially. And now you're starting to save for real, right? Now you're finally starting to put away money in an account other than a retirement account through your job. Well, let's look at the other option, right? The other option, we still have that house. We own that $775,000 home. It's grown from $500,000 to $775,000. So we still have that. But we also have that brokerage account at $357,000. $357,000 in a non-retirement account. Sure, we have debt, right? We have debt of around $390,000, which is left on the loan, right? We still have debt. But is it really that bad, right? Is it really that bad? I want you to think for a second. Think about if you had $350,000 in a non-retirement account to your name right now, right? Maybe you do already, but let's just add another $350,000 to it. What would you do, right? Again, $350,000 in a non-retirement account. Right? That's a big deal. Would you retire early? Right? Maybe you would retire at 45 and you'll actually have cash to dip into other than a retirement account, which would incur penalties and tax. Maybe you've always dreamt about starting your own business, and that $350,000 would allow you the flexibility to start your own business. Maybe the home that you bought in this scenario here, maybe this was just the starter home. This was never intended to be the forever home. But now you have $350,000 to put towards a down payment on the forever home. And guess what? Now you're going to go ahead and rent out this current home. And now you have a real estate portfolio to your name, right? You have this rental property now, and you bought your dream home. Is it making sense, guys? Is it sinking in? I really want that to sink in. Because what you're listening to right now, that is balance sheet optimization right there, right? That's balance sheet optimization. You talk about how the rich get rich on other people's money, right? That saying isn't about robbing people. It's about utilizing debt financing, like a mortgage, to your advantage, right? Because wealthy people know it's highly ineffective. What good is it to be worth millions of dollars if all of it is tied up in something you can't even use? You can't even tap that capital to make more money. It's all locked up. But in the other scenario, right, you're paying off your home, but you've built up capital to deploy towards other ventures that could make you even more money down the road. Now, sure, right? Some people are saying, well, mathematically, your total net worth is still higher if you paid off your home, right? Maybe it is. I mean, mathematically, sure. If you rush to pay off your home in 9 years, in this example, your net worth, excluding your retirement accounts, is $775,000, right? It's all in the home. The other example, your total net worth, because you have that debt still on your balance sheet, is $742,000. So slightly lower, but is it much more effective and optimal? In my opinion, absolutely. And keep in mind, this is a pretty extreme example, right? The math is far skewed in favor of the mortgage because the mortgage rate is 6.5% and our growth rate is only 5%. And yet still our balance sheet is much more optimal here. So if you have extra money coming in every month, I don't want you to rush to pay off your home, right? Be my guest. Do what makes you happy. Do what makes you sleep at night. But I would encourage you to view alternative avenues for that cash, right? Of course, we discussed investing in a brokerage account. But if you haven't maxed out employer-sponsored retirement accounts like a 401k, 403b, etc., right? Maybe you max those out because you have extra money to do it. Maybe you take advantage of backdoor Roths and mega backdoor Roth opportunities. Maybe you explore real estate. Maybe you explore business ventures, right? There's tons of different ways to utilize that capital. But most importantly, let's set all the math and wealth accumulation discussions aside for a moment. Most importantly, enjoy your money, right? If you had extra money coming in every month, think about what that would do for your family, right? Maybe you want to give your kids the life that you didn't get to have. Maybe that means a world vacation that you could never afford growing up, but you can afford to give your family that experience, right? Enjoy your money. So many people get so caught up in these ridiculous saving strategies, right? This, in my opinion, is one of them. Because it's highly ineffective. Locking your money in a highly illiquid asset, no matter how you view it, I think is very ineffective. And on top of that, what if that means putting off doing what you really, really want to do because you're tying up all that money in something you can't tap unless you sell your home or do a cash out refi? So bottom line, guys, I know that there is a temptation, and there always has been, even when rates were lower, to take money and try to pay off your home faster, right? That has been a debate for years and years now. But it's even more prevalent now because interest rates are higher. Even with interest rates being higher, I do not see in this environment the reason to accelerate paying off your home, because at the end of the day, rushing to pay off your home and adding more to the principal every month, all it does is create an ineffective balance sheet. And plus, on top of that, even in this higher interest rate environment, you got to remember that there is a possibility, I'd say a decent possibility, that rates will eventually start to drop. And when they start to drop, you can always refinance at that time, right? You're not stuck with this mortgage rate forever. It's the cards you're dealt now, sure, but it doesn't mean that you have to rush to pay off your mortgage just because the interest rate is high. Think longer term. Think about what your balance sheet is going to look like in the future, 10 years from now. And if all your wealth is going to be tied up in your home and trapped in there, then I would encourage you to think twice about this particular move. If you enjoyed today's content, please subscribe to our podcast, subscribe to our channel, and be sure to like this content so other people can see it. I hope you found this helpful, and I hope you have a wonderful rest of your day.